weekend. Ira Epstein with your weekend edition of your financial market wrap-up. And this wrap-up is for Friday. We're at the 27th of May, 2022. I want to get this done myself as I'm going out of town for a few days like other people. Not far away, though. I can come right home if I have to. So the big question, and I know it's going to be asked, it's going to be all over the weekend talk shows that are in finance. Has the stock market seen its lows? The buyers came out. Okay. First off, I don't think volume qualifies to say that this market has made a low. I think the rally's on lower volume. Number two, after 7 weeks in a row of a lower S&P close, you're overdue for a correction. Markets go in phases. They'll stepladder down often, and then eventually you've got to get a correction to that because nothing goes in a straight line. Trees don't grow to the sky. Bear markets don't grow to the sky. It doesn't work that way. You get corrections. So at any point, a 10% correction, yeah, that can come in. So the first thing to do is understand what you've got. We just come to the end of a cycle, if you will, on the downside. It is not the beginning of a bull market, in my opinion. If I'm wrong, I'll hang my hat on it. May 27th, I'm saying no, this is not the start of a new bull market. It is the end of a phase to the downside, a cycle leg. That does not mean the legs can't go lower. We're not at that point yet to make that decision, in my opinion. Bonds and notes continue to march on higher in terms of futures, which keeps dropping yields. The argument there, of course, is, again, oh my gosh, is the market done its Fed's job for it? Well, I don't think so. However, there's the market that I'm more concerned with in terms of, is inflation on its own starting to ebb lower? I don't know. You can't go by energy. This is Memorial Day weekend in the U.S. The demand's going to be strong for gasoline on all the roads, crude, and then you got to replace what we're going to burn through right now back into the stations and all. So that takes about a week afterwards, and then we start seeing a better picture. Food prices, well, the planting is just going in. Too easy to look at. So we'll take a look when we get to these markets now as to what we've got and seeing it. When I look at a monthly area chart of closes, monthly, that is just not a bullish picture. The market is still underneath everything. For the month, you're up 0.68%. Whoop-de-doo. Does that look to you like it's a big turnaround? Not to me. When I come to the weekly area closes, yes, we had a 6.5%, nearly 6.6% gain. That's impressive. So the market is saying, finally, it found some footing. But I look at this and I say, okay, but there's a lot of resistance. Often the first challenge in a bear market of that 18-week fails. In other words, you came down, you challenged it, and then you fell apart again. I'm looking for it to come up, and in some manner, I wouldn't be surprised if these lows are challenged again. When I come to the bar chart to see the action, you can see this wave that came down, and the market has a pattern of lower highs, lower lows. That wave hasn't ended on this chart. This is still a full-fledged bear chart that found its footing for the past month. This is a weekly chart. Each week, it's been hitting the 100-week average. In addition, it was hitting the Bollinger Band 1, 2, 3, 4 of that 5 weeks in a row. And the market staying under the Bollinger Band only 5% of the time. So no, you're not going to do that very often. That combination can lift the market. But guess what? I think the bears are going like this with their hands. And they're saying, let's look at momentum. Momentum is turning up a bit. The market held there. The trend is down. Maybe the resistance is closer to 43.06, 150 points from here. I think they're getting their sell orders ready. In the Dow, the pattern's different. You have a higher high, lower low. So you didn't have a trend. You had a vertical price drop. And unfortunately, I just can't show it there. This didn't lock in. But on that drop, you came into the Bollinger Band, the 100-week average, and you held it. Okay, you bounced away. In addition, last week you had an outside week down, and this week you took that high out. When that occurs, it's often, the word is not always. I'm doing this outside week daily course whatever you want to call it, on outside weeks or days. And that often leads to a challenge of the closest moving average above it, which in this case is the 18-week. Another story for a rally. In the NASDAQ, the market momentum has been down. The market did not stay with numbers both under 20. You've held again the lower Bollinger Band. If you knew nothing else, and I had you in a classroom, you don't think this combination of the 100-week in green and the red, the 18-week, is a resistance point? Okay, go back to charting school. It most certainly is a resistance point. You've had the swing down and a bounce, and the strongest of the markets, at least on some of the work, has been the Russell, but it too just got down to the 200-week average, the lower Bollinger Band, couldn't stay under it, and you're getting a bounce. I think this market's loaded with resistance between 1962 and 2027. So, am I in the bear camp? I am. Do I think that we ended a phase of testing all these lows down here for the moment? I do. Am I bullish? I am not. Okay? That's simple. I'll hang my hat on that. Then we get to the 30-year bonds where, lo and behold, it lost its embedded reading. When you lose an embedded reading, it's not uncommon that the market from there tries to get to the 18-week average of closes, or the closest moving average. That could easily happen here. That would be one heck of a move. You would really get the buzzsaws going if that started happening. People would be scratching their head, and mortgage rates at 5.1 right now would go even lower. That's something that you'd be looking at. The 10-year did the same. I understand better the argument, have we seen the peak on interest rates in the near term, than I do in the stock market. Then the stock market pundits I would, turn around and say, well, Ira, if you think that we've seen a peak in interest rates, don't you think that we're too then low in the stock market? I understand both arguments. But as a chartist, none of this is bullish. Losing this momentum on a bounce isn't bullish. You didn't turn the trend up. You may have ended a downswing. There's a huge difference between the two. And remember, we're going to get closer to the Fed decision soon. In the dollar index, the flip-flop. The whole parade changed on the dollar. The dollar was by itself for months as the U.S. was fighting the idea, would the Fed embark on raising interest rates, and was it behind? And you remember these arguments here. The 8-ball. It hadn't addressed the transitional inflation, transitional inflation, and they got that wrong. It was more of a baked-in inflation, and they had to catch up. And interest rates soared, and so did the dollar, because we were the country out there that were saying that. European Central Bank, oh, no. We're not going to join that parade. We don't see the same pressures you do. We see the crude oil, which we have no control over, and other things, but internally, no. That picture has changed too. Now they have joined on board. So as these other banks are joining on board, you got to say to yourself, well, wait a minute. Maybe there's more of a play there than there is in the dollar, which has already discounted that news, and you start getting the information. That's part of the psychology of it. I'm not going to take that. So you've got a lower low, you got a higher high, the market's trying to give you a rally on that, and away you go with it. I can live with this. A short covering rally and the end of a decline to the downside. We then get to the Canadian dollar. You have in this lower highs, lower lows, right into the 200-day average, the lower band. What would I have told you at that number? We can get there. Why not cover shorts? First challenge of the Bollinger Band and the 200-day average. You'll hear me say that. I also was looking, would the market hold the 100-day? It didn't. So on that leg to the downside, that's where you no longer want to be holding shorts. Now what started happening is the markets come alive. Where's the first resistance point? Right here. What's wrong for the bears, I think, is the risk factor all the way up here to 80.24 is too much to get short at 78.62. It's 160 points. They generally don't like to risk that much. So I think you're sort of in no man's land for the moment. In the Japanese yen, will you lose the embedded reading? If you do, you might get your turnaround in this, and the market makes its run to the 18-day average. Do I think so? I don't know. I can see the end of the bearishness because this market's been on a tear to the downside all of 2022. But is it suddenly bullish? I don't think it is. I think this is the reaction to a big break, similar to the stock market. 2 months almost of straight down prices get you bounces. Where are we at? 5 months down get you bounces. Bitcoin in big trouble. It's not even looking any longer to marry itself to the NASDAQ, which had a big rally today. That's not good. So what's going to rally it? I don't see anything. So it's on its own now. It has broken its tether to that market. If it keeps dropping down here, the next spot is 22,000 as support. You'll have an idea that it is just a delayed reaction wants to lift. If it gets over 31,400, that would break the pattern of lower highs, lower lows temporarily. But what has it really done? It's created a gorilla glue. It's every week now hitting the lower Bollinger Band and just sitting on it. That's bearish. Then we get to the Brent WTI crude, still running about $4. And when you take a look at the market, higher lows, higher highs over the 18-day average. Next target is 125. Can you believe that? 125 a barrel. What would break the uptrend? Okay, taking out 193. Barring that, you've got a market that is not anything. Momentum is flat here. I think the pros are willing buyers on breaks to 106.63 as long as you don't first go up and then break down onto what we'll call an outside week to the downside. If it were to just break, I think they'd be buyers. In WTI, same thing. The pattern is bullish. The target's 121.35. You see the $4 difference in them. The momentum is still up. Now, what we have to remember is you're going to have to change in the crudes and move away from the Julys, the way they do this now. Got to go to the August next week when we do the dailies. Remember, we got to make all those changes, but we'll get them done. The difference is the spreads generally carry the same. In any case, I think that if you were to just drop, you'd see the support here. But if you first at all take out this week's high, I don't think you'll get buyers on the pullback back to this number. I think they'd go, okay, is that a top? They'd start going a different thought process. Gasoline. Okay, you know what you're going to hear all weekend. You're already hearing it in Chicago. I was just watching the local news before I'm doing this, and they're at the plazas as people are going to Wisconsin, Michigan, all over the place, and they're going, oh, these gas prices. So your tube buddy is going to be going on, your gas buddy, two buddies from Facebook and YouTube. Your gas buddy's going to be all over. You drive on the road, you're going to hear, where's the cheapest gasoline you see? We get this every year, but it's really a big event now because these are prices nobody's seen. And I got to tell you, as it's going up, it's getting stronger. The market's not showing any sign that it's overbought. So this is still very much a live and well bull market. Why not go for the 417 level? So you put it all together, you have bullishness in this, and recently, I'm getting so many people writing, Ira, I love that pivot point. Would you bring that back and show us? Let me explain what this is. One of the biggest names in charting developed this. I can't mention him because he was barred by my industry for doing things very wrong, not his trading acumen. In doing so, he had developed this. He was a younger trader. He wrote books, and he did. He turned no money, wrote a book, How I Made $1 Million. And I saw it happening, contacted him, worked with him, and he managed money in my firm using this technique. I can tell you firsthand, people were making killings. A problem happened. And the problem that happened with the technique is he got bigger than the market. Sure, if you write him, he will explain it. He was working with 2 or 3 big brokerage firms. I was one of them at a very large discount firm at that time. And I'd call him on the phone and I'd go, could you please take more accounts? I can't. I can't even get these orders in and get fills where I'm going. And when I come out, I'm stomping myself because you didn't have electronic markets. This was in the 80s. Fast forward. Okay, people make money, people lose money, whatever. I knew that, and I see it today. Fund managers, before I moved it on, fund managers get too big for the market sometime. You'll see they'll go, I just have too much money under control. I can't deploy it. That happened to this gentleman also to a degree. And I learned from that, because the market is finite in size and the commodity markets are nothing like the stock markets. Don't even think they are. They're nothing compared. The FX market is. FX market's a monster. It can handle anything you want to throw. Treasury market's a monster. Throw all you want. But the general commodity market, you want to trade grains? No, it's nothing like that. Cattle's a joke. But you learn that because traders don't even remember these things anymore, you dig them out, you dust them off, and you go, and you look at them. I have used this ever since the 80s. So that gives you an idea. I use it for timing. I have traders that I know use it for their day trade techniques. It is not a take-home technique. In other words, you don't put on a position and take it home base this. You're supposed to be flat at the end of the day. But that gives me in the futures markets, Monday through Friday, basically 23 hours a day. The market's only closed 1 hour, so I'm using it to get in, out at different times. I'm looking at points that I'm going, and I'll put out special updates sometime. The market's overdone it. I don't think we're going to reach up to that band that I want you to come out, and away you go. So the concept of it is you take the day's range. There's a formula. I teach it to you. It's all in a video series. We go through it. You can then do it by hand with your computer any way you want. You're going to get 2 resistance points. I preferred calling them sell points. He called them resistance 1 and 2. And then support 1 and 2. I hated that. I like buy 1 and 2. Why? Because S reminds me of the word sell. And I realize it's support. And the concept is you're buying at the support, flipping out at the pivot. Selling on the way up, flipping at the pivot. Can they go through the first and second? Yes. He had no technique, though, to use with timing of momentum. And that's where I changed his technique. And I applied the way I teach stochastics to this, and I discovered something that I thought was pretty neat if you're an in and out trader. Is there a charge for the course? It's absolutely free. Okay, I want to show you how I teach because I have another course coming out right behind this on outside days that I'm still working hard on to prove points. Right now I'm proving a lot with that. How do you get this? It's free. Just go to our website over the weekend under free offers on the top left, or you can take your cursor, just follow it up here, give a click, and you'll be into the free offers. Get it from there. I'm Ira Epstein. Drive carefully, don't eat too much, and I'll see everybody on Tuesday.